What's going on, everybody? It's Blandon here from mortgagehq, and today I want to share with you some common mistakes that I see beginner developers make. Now, working in this industry have enabled me to see all kinds of property deals. Some are just so amazing that people won't even believe until they can actually see it. But at the same time, it's unfortunate because I get to see some of the big mistakes that property investors make as well. Now, if you stay till the end, I'm going to share with you one secret that professional developers use to see whether or not they should go ahead with a property deal and whether or not it is a winner. Because I'm a mortgage advisor, I rate funding the most important. Because if you put yourself in a strong funding position, then you can at least finish the project, you can hold it for renting, or you can sell it to liquidate your profits. But if you don't have enough money and you're not in a good position for more funding, you might get stuck halfway and you're forced to sell an unfinished property at a discount. You could lose hundreds of thousands of dollars. So here are 5 common mistakes that mum and dad property developers make from a mortgage advisor's perspective. The first big mistake, they don't smash the like button until it turns blue. So here's your chance, guys. Smash that like button, go on. All right, seriously. Mistake number 1 is low equity position. Now, if you guys seen our other development financing video, you will know that typically in a development position, you want to have around 25 to 30% deposit or equity. But the mistake that they make is that they underestimate what the actual cost of the project is. So even though they thought they have enough equity, they end up short. Beginners usually focus on construction costs and some of the infrastructure costs. But one of the biggest costs that they miss out on and they underestimate is site works. And sometimes the civil infrastructure requires a more creative solution as well that's going to be quite costly, unless you have stormwater, wastewater already accessible on your site. The costing is important because the bank is only going to lend you around 75% off the total cost of a project. So if you run out of equity or cash, then tough luck, you might not be able to finish it.
What? No!
Second is that they do everything themselves. Now, I get it. When we see that bill for a few grand here and there, we just want to sort of say, man, it looks like a pretty easy job, why don't I do it myself? But here's the thing, we're competing with professionals that make very good money doing what they do because they're solving a real problem. And they're professionals, they do it every day. So don't bother saving a few grand for managing the resource consent. Don't save a few grand to manage a few contractors yourself. Beginners often underestimate what the job actually entails. They only see the bill and they think it's an easy job. If you really want to save money, try and get maximum 3 main contractors. The first one being someone that will take your project to the building consent stage, such as an architect or planner. The second one being someone that will do the whole construction and the infrastructure. Now, sometimes the construction company might not specialize in the infrastructure, they'll manage the infrastructure and it'll be an added cost. So if you really want to save money there, you could find an infrastructure company that specializes in that area and they can manage that process yourself. But however, if you get the construction company to do it, you are delegating that risk to them. So there is an upside for that extra cost that you pay them. Number 3, no fixed price contracts. The bank usually break down constructions into 2 types. One, we call this labor only. Now, this is when the client actually wants to manage the whole construction themselves. They're managing all of the subcontractors because they see this cheaper, because they get these quotes. And what happens is these quotes can change when there are more costs to be had during the project. The banks are very scared of this because it's easy for the cost to blow out and you have a cost overrun. This is related to doing everything yourself. The other way to do it is fixed price contract, which is what the banks are happy with. It does cost you more, but you mitigate a lot of the risk and you sign a contract for a fixed price. And if you must manage it yourself, you could again go back to using 2 to 3 main contractors that can give you the fixed price contracts. And number 4, not maximizing a site. Now, you wouldn't build a mansion in a state housing area. And you might not want to build a big family home by the university. It's not a desirable location. Building the right type of property in the right area is going to maximize your return. But more importantly, understanding the full potential of the site based on the unitary plan is actually going to give you far greater return. I'll give you an example. I've seen clients building a 4-bedroom house on 1 story on a site where they could actually build 3 smaller terrace houses for just a little bit more money, but they would get double the income. So in that situation, they're leaving a lot of future value and cash flow on the table. You also need to consider what area you're in, because some areas might favor car parks. And so building more houses might actually hurt the profit margin. So having the right professionals in your team is essential. And mistake number 5, opportunity costs. Opportunity cost comes with numbers, and numbers are the most important, period. But what is opportunity cost? Is looking at whether or not the decision that you're making with the resource that you have, is it the best use of your resource? Is it giving you the best return? The number 1 mistake that mum and dad investors or property developers make is that they base the cost of the property on how much they actually paid for it. Now, if they bought it a few years ago, the deal is always going to look great because you bought it for real cheap, there's capital gains, and so the construction seems pretty cheap and makes sense to do it. However, if you want to look at the opportunity costs of the site, meaning you have to consider what you could actually sell that property today in the current market, then the construction might not look as attractive. And if you don't calculate your opportunity costs, it's easy to overcapitalize. Simply put, the cost of building the new properties is pretty much the same as buying something in that area. So you don't really want to go ahead with that. So when you're doing your numbers, you always want to base the property on today's market value. And sometimes if you can sell that property at a good margin because there are developers wanting it, you might just let that go because the profit margin might look better. So it's important to do your numbers and look at those margins. Now, did I miss any major mistakes out? If I did, leave a comment below. I love to learn from you. Now, the secret that professional developers use to check whether or not a property is feasible for development or whether or not it's a winner is the margin. They are always looking for 25% margin. And if you have that in the project, the bank is more inclined to lend to that project as well. And what that is say for example, if a property project is going to cost you 1 million, the end value that you're looking for is 1.25 million. That is 25% margin. And it's a good indication on whether or not that project is feasible or good for development. Personally, I've seen projects where there are 30, even 40% margin, and some of those projects are amazing because the developer really knew how to maximize the design, the unitary plan, and manage their costing as well. Now, if you want to see more case studies around property investments and developments, do check out one of our online masterclass in the link below. I'll see you guys in the next video.